Today, we have a big treat for you. Every month, we do what's called the Reads Report. And in the Reads Report, my partner, Mark Boucher, and I go through and we outline all the different factors that are driving the macro environment of the markets around the world. And we do a detailed analysis of each of the different asset classes, and we detail the top stocks to look at to go long, the top ETFs to look at to go long, and the top stocks to look at to go short. We do this all in a live webinar in which we take questions at the end, and it's an incredible session that really helps our students be able to frame their investment thesis and their trading ideas for the month. So my gift to you today is that we are going to share with you the beginning of our Reads Report that we did yesterday. We're going to share the whole macro commentary in which you can hear my partner, Mark, talk about what's going on in the world. And Mark is one of the best macro minds I have ever seen. He's probably the best stock market timer I have ever seen. And if you just watch this clip from our Reads Report yesterday, you will learn a lot and you'll feel much more in the know about what to expect in the coming months. As we go into December, December is a notorious trend-killing month. It's a notorious year-killing month. It's a month that has seen hedge fund managers lose their entire year in the month of December. So it's always important to understand how December behaves. December is a wild card every year in terms of how the markets behave, particularly as we start moving towards Christmas. So from December 15th, 20th through Christmas week up till New Year's, the market can behave very erratically. So one of the things you always want to remember is that when there are big trends on, you tend to have everybody on that move. And so any kind of counter trend moves, two things happen. You have players in the market who have profits and they don't want to see those profits disappear. This means the loss of management fees and the loss of bonuses. So they get hyper aggressive to protect their profits in the month of December. And so because there's this hypersensitivity to the protection of profits, you often get these violent one-way moves that happen in December as everybody is liquidating to try and protect their profits. This often happens, and then the trend resumes in January anew. So as we go into December this month, we have a lot of markets that are in transitions. And so we don't have, one of the things Mark and I spent a great deal of time doing is trying to identify the top trends. But as we come into the end of this year, the markets that have been in top trends in the last 3-4 months, they are all in a state of transition. So when we look at this list is actually very small. There's a couple common things you can see. You can see one, you can see weakness in the Canadian dollar. This is showing up in these crosses, Euro CAD, Sterling CAD, the New Zealand dollar, Kiwi CAD, and then on the downside, you can see the CAD versus Swiss. So the Canadian dollar is weak, but notice what's not in here. It's not in here versus the dollar. It's in here against other crosses.
Chuck, we lost your camera.
There you go.
Awesome, thank you.
So you can see that the New Zealand dollar is in here, both as a long and as a long here against the Aussie dollar, but there's not a lot here. Then when we look at outside of FX, you'll see we have natural gas. Natural gas is really interesting to me because natural gas is enormously high volatility. And there's a lot of fear going into winter surrounding natural gas. So one of the things I always remember is if there's fear in the market and people are really scared of the upside and it's going down, it's probably going a lot lower. And then we have wheat and we have coffee. Wheat was making new lows today, and coffee has been down near its lows. Okay, so in the WAM-RS report, this is one of the things that's going to jump out, is look at the shifts in the last month. You can see dollar index is a leader on the downside. It was one of the strongest trends of the year. It really fell apart. Crude is weak. And on the upside, yen, which has been our favorite short all year long, you can see the yen is leading in relative strength, increasing on the upside, along with the euro and the 30-year bond. You can see in the WAM relative strength 20, you can see all of these that have been going down this year that are in this transition phase and rally. In the sector ETFs, you see some big shifts in the sector ETFs. XLE, which has been a leader all year, it's still not bad. It's still up there, but it's been weakening. But you can see XLK, which has been beat up all year, coming off the bottom really strong. Emerging markets coming off the bottom, and then communications and staples coming off the bottom. And again, you can see these big relative strength shifts going on as the market is transitioning off the lows. Okay, so with that, I'm going to turn it over to Mark as we get more into the macro picture.
First thing we want to look at today is the yield curve. So we've got here, this is the 3-month 10-year yield curve, and this is the 2-year 10-year yield curve. And a couple of things about this. Generally, when we have both the 3-month and the 2-year in inversion, like we have now, every single time that's happened since World War II, we've had a recession somewhere in the next 12 to 24 months. Okay. So we've been inverted. And the other thing to look at that I want you to look at is the degree of inversion, right? We think of the inverted yield curve as like the gas pedal or brake of lending, right? Because banks basically borrow short-term and lend long-term. So when the short-term rate is above the long-term rate, doesn't make sense for banks to lend. They're going to lose money. They're going to borrow short, lend longer. The short rates are high, so they're borrowing at a higher rate than they're lending. Doesn't make sense. So lending stops. And that's why it's sort of a cause and effect relationship, why an inverted yield curve leads to the much lower degree of lending that slows down the economy. So the degree of inversion on the 2-year is more than we've seen since 2000, and on the 3-month 10 is getting as high as 2000s. Generally, the higher the degree of inversion and the longer it lasts, the deeper the recession. The other thing I want to point out about inverted yield curve, it's really important. I want you to understand these green lines are the bottoms in the market, just coming after the bottoms in the market. What I want you to see is you don't get a bottom in the stock market and since World War II, when you've had an inverted yield curve, until the yield curve steepens to at least 100 and often much more than that. Well, what that tells us right now is we're not in an area where we would actually be looking for a sustained bottom in the market because the yield curves are still heavily inverted. That means lending activity is being cut back substantially, and that's going to weigh on growth ahead. And we haven't had the steepness that then brings you lending back in and starts to turn the economy around. So realize that we have never not had a recession since World War II with this kind of developments, both of these yield curve being inverted. Realize that deeper inversions tend to correlate with bigger recessions, and realize that the market is unlikely to bottom until the yield curve starts steepening at least to about plus 100. We're not close to being there. The other thing that's happening this time that doesn't happen very often is the global yield curve is inverting. The global yield curve has been a good predictor of recession for the global economy or for at least 2/3 of the main economies in the system since World War II. This tells us that we're likely to have a recession. It's likely to be a global recession. And then the other point a lot of people bring up is until the yield curve starts to come back, you get most of the decline in the stock market, generally in bear markets. So look at when you started inversions and how much more you had to come. We haven't really gone that much since we started our inversion here. It's likely that we're going to go more, especially with the inversion being so deep. So from a sort of a liquidity perspective, it's not likely that we're seeing a sustainable bottom here yet. The other thing I want to point out is the Taylor rule, which is something that policymakers use. And in fact, John Taylor wrote a book that basically recommended using this as a primary tool of the Federal Reserve for where interest rates should be. Look at where the Taylor rule says interest rates need to go. Above 6% if we're going into recession, and if we're not, above 7.5%. So it's possible that the Fed has more tightening than the market is realizing yet. The Taylor rule implies we need to go further than analysts and then Federal Reserve officials are currently talking about. The other thing that's important to note is what's happened to the savings rate. Savings rate exploded higher when we got all those stimulus checks, but that's mostly been spent, and now the savings rate is at new lows since World War II, really. Okay, now think about this. The US economy for the past 20 years has really needed cheap capital. Savings is one of the sources of capital, and without a large pool of savings that it's had. So now that savings is depleted, if interest rates go higher, it's going to be very difficult not to have a further recession. We have a ton of macroeconomic tools that we look at, that we compile, that have had a very good track record at predicting recession. And here are a couple of them. One is leading economic indicators, going way below zero, and we've done that recently. And the other is the leading economic index falling below its 18-month moving average, and that's happened too. Both of these are now clearly predicting recession. And so we're going to be looking at a bunch of different macro tools. They're all in concert predicting recession for the most part. Here's another one. Chicago PMI falling below 40. See, every time that's happened, there's been a recession since World War II. It's called 8 of the last 8 recessions, and it's not had any misses. So this is yet another tool. A lot of PMIs, we'll look at ISM PMI below this. They're all telling us that we're likely heading into recession pretty quickly here. This is the ISM PMI falling below 50, which forecasts recession. And then I want you to realize that, okay, so we've got leading economic indicators, we've got PMIs, we've got the yield curve, we've got a lot of things telling us that we're very likely to be in a recession and potentially a deep one. And what's happened to stocks is they've fallen on par with bear markets that have not been accompanied by recession. So it's likely if we do go into recession, we have more downside based on just the average that markets fall when you get a recession and a bear market. Other thing I want you to notice is that we have models. These are models from Morgan Stanley that basically do a pretty good job of anticipating moves in both earnings and in leading economic indicators. And both of these are collapsing. They're falling very sharply. Suggests that we're going to have earnings declines that could be very sharp, and we're going to continue having a degradation in economic indicators ahead in the recession. The normal earnings decline during a recession is a 26.5% decline in earnings. We've had something like 5% so far. So we likely have a substantial amount of earnings declines coming up, either starting in Q1, most likely, or in Q2. We're going to start to get earnings declines. And what generally happens when we start to get earnings declines is that analysts begin to say, oh boy, we haven't really anticipated this. Analysts are looking at double-digit earnings increases next year. So what happens usually as you go into recession, the recession starts to bite, is that analysts trip all over themselves to revise their estimates lower. And that is one of the things that leads markets to fall sharply. And then the other thing to realize is just looking at the average bear market with recession, we haven't fallen really to the normal average levels in anything, in ISM, PMIs, in unemployment, and in earnings decreases. Okay, and Goldman Sachs has a good chart here, and they're talking about bear market since World War II, and they have cyclical, which are a lot of the non-recessionary bear markets, and structural, things like when we have a bubble of high degree of overvaluation, or we have structural problems in the economy, where we have talked about how we have a lot of structural problems in terms of supply chain problems, in terms of inflation, in terms of a lot of things. Normally, when you have a structural recession, you have the deeper bear markets, over 50% and averaging over 40%. And they last longer. Instead of lasting an average of 15 months, they last an average of 2 years. Another thing that normally happens in a bear market, particularly one accompanied by recession, and this didn't happen in 2020 because as soon as before we started the recession, we got massive stimulus. So it's a very, very short recession. But generally, during recessionary bear markets, you get valuations that correct to more normal levels. All we've corrected to, by the way, this is the biggest valuation splurge, the highest valuations for stocks ever, including 1929. And we have only just declined back to the highs of 2000. So likely, if we do have recession and we're going to get a bigger decline in valuations that accompanies a normal bear market accompanied by recession. Now, here's the bull argument. You always want to understand, what if I'm wrong? And we have fail safes and all kinds of things, because the markets can do anything. Usually they follow pretty closely what all different theories say, but we want to understand what the opponents are thinking here. The bulls are thinking, they have a good point. A lot of times when inflation peaks, you get a bounce in the market. So we want to be watching for how sustained and how substantial that drop in inflation becomes and how the market reacts to it. My suspicion is that if we start to see recession really develop, the market will shift its focus away from Fed tightening, like it normally does, towards how bad are the earnings going to be hit and how bad is the recession going to get. And that's when you usually get that final phases of the bear market, where it's actually about 2/3 of the decline in stocks most of the time. The other thing to realize is that this is a nice study by Research Affiliates. It goes back and looks at, since World War II, the times when inflation really flared, went above 7%, went above 8% for a number of months, which we've reached all those requirements. And in those situations, in developed markets since World War II, and really many examples, it's taken many years for inflation to come back below 3%. Right now, the market is discounting that it'll take less than a year to get back down. The other thing that we've talked about before, which remains the case, you haven't had the normal capitulation that you get at the end of a recessionary bear market. Even the 2020 recessionary bear market, even though it was just it was a deep but very quick recession, we got the VIX rising above this 40 level approximately. And that's where usually you get, that shows you the kind of capitulation you've had. We really have not had anything like that. And that's because we really haven't had the retail investor capitulating yet. The retail investor has not capitulated, and that's something that normally happens at the end of a recessionary bear market and leads to a bottom in stocks. We haven't really had that yet. Other thing to realize, and it's just food for thought, but here's the 1929 to 1932 bear market. We had 9 bear rallies of over 20%, all of which failed and led to new lows. And that was from a historic bubble levels that we've surpassed. Now, I'm not predicting we're going to have a 1929 to 32 bear market, but I want you to understand you can have a lot of bear rallies that are very steep and still the market turns down and makes new lows in a bear market. And this is kind of a bear market analog that basically shows bigger bear markets that accompany recession. 1973 to 4, 2000 to 2002, 2007 to 2008. You can see that basically it's followed the script pretty well so far. It's rallying a little more on this bear rally than the usual, but basically we're about halfway done with from major bear markets of downside potential, and we're about halfway done in terms of time. So if we start sliding into recession, first quarter of next year or a little past that, this is going to be an indication that this is going to be likely be more operative. Okay, so we can see that from a macro basis, it really looks like we're heading for recession with pretty high reliability, and that we've got valuation problems, and we've got all kinds of situations that are likely to lead to further downside. But we always want to confirm that with internals and internal technicals that we look at. These are our supply and demand indexes, and they're a bit of a mess, but I want you to see that the demand index in orange is still below its downtrend. The supply index moves the opposite direction of stocks in royal blue is still above its long-term uptrend, and the net of the two is kind of in a downtrend, but in kind of a trading range. None of that. And the other thing I want you to notice is we haven't really had a very steep decline in supply during this recent rally, and we haven't had nearly as much of a rally in demand in this rally off the October lows as we had off the August lows. And we haven't had anything like this big move in the spread that we had. So really from an internal basis, at least so far, that mid-June to August bear rally has been quite a bit stronger than the bear rally we've had so far. Normally, when you get a major bottom, that's when you get some of the biggest moves in these kinds of internals in favor of demand and against supply. And we're not seeing that yet. So far the internals are saying, yep, this bear market is likely continuing as well. Now, in the June to August rally, you remember we started getting up to the point where a couple of these were breaking trend line, not a plurality, but a couple of these were starting to break trend line, and we were starting to say, okay, we really need to watch things. We're not quite there yet. You can see that all of the major internals remain below their long-term trend lines right now, but we're getting a little bit close. What I would say from the major internals is if the plurality of these broke clearly above their downtrend lines and broke their August highs, then we would have to throw in the towel and say, all right, the internals are telling us something different than the macros, and this rally may last a while. Maybe we'll have a double dip or something like that, but we're not seeing that yet. And we're not even seeing, again, we'll look at the S&P really has some pretty big resistance between 4,100 and 4,200. That is also at the trend line, and it's around this 200-day moving average. This is one of the areas, along with this 43 to 4,400 area, that we would look for a bear rally to peak. So you start watching that pretty closely. The other thing that we like to have as a fail-safe, just in case a bull market starts and we haven't really caught it yet, is we have these sort of weekly thrust indicators, and we have also daily thrust indicators. We have about 50 of those, and normally we get at least a dozen of those going off in the first couple months or so of the rally. We're not anywhere close to a dozen so far, and our weekly thrust indications, 1, 2, 3, 4 of them that we watch, and if we were to get 3 of those to go above, we would start to say, okay, but something's happening that we're not considering, but so far none of those have gone above. So we're not getting indication from internals that our macro outlook is wrong. What I would suggest people do is start watching for a couple things that happen with much more commonality in bear rallies. And that is we get these 5 to 21 or even 5 to 34 bar daily pattern double tops or head and shoulder tops that happen around 200-day averages and around 50-day averages, or around some real resistance levels. We're at a resistance level in this 41, 4,200 level. If we were to get some kind of a double top or head and shoulder top on a daily chart, 5 to 21 or 5 to 34 days, and then break down, and we break down with either 80% down volume or strong volume traction down. That's what all these boxes are, and they tend to happen much more frequently in bear rallies. The other thing that often happens, it's important to understand, is that you get false breakouts a lot in bear rallies. In other words, here we have a high, we actually make new lows, and we break that high, but we can't hold it. We instead make a topping formation and start to break down again. That's a false breakout. And you find that false breakouts tend to proliferate substantially during bear markets. So you want to, when you break above a level, you don't want to just say, okay, that's it. It must be a bull market. You want to start watching it really carefully. Is it going to fail here, as it often does during bear markets? And then the other thing that you can watch is this percent of the S&P above their 50 DMA, which is this indicator above here. And you can see that when it rises above 70 and then falls back down below 70, it's been a very good indicator that bear rallies are over. So far, we've risen above the 70 level and we're still above it. But I would watch for this to fall back and close back below 70 as one indication that the bear rally could be over. Watch this uptrend line carefully. It looks like we're possibly forming a head and shoulder top here with a shoulder here. Let's see if we get some kind of a topping formation, could get a double top, and it could be at this 42 to 4,300 level. It's possible that this rally could extend as long into February. As long as our major internals don't really tell us we're wrong, our thesis that we're in a bear rally is likely to obtain, and we're going to be watching for a reversal back down. You can see that the market has had a nice trend channel, and we're back at it, and we're back at this trend channel resistance at a point where we have this high volume node resistance in this 4,200 level that is really a key level we'll be focusing on to see if it can hold or not ahead. The other thing is that we had a lot of negative sentiment that lasted for a really long time here and got to extremes, and we went to pretty much extremes in October as well. But during the bear rallies, we have bounced to overdone levels, and we are now at overdone levels on the fear and greed index, suggesting that sentiment has shifted to the bullish side. That's when you want to start watching for peaks in bear rallies. The other, I really think it's really important to watch the trends in bonds and the dollar here, long bonds. So this is the 10-year Treasury yield. And again, this broke out above a trend line on a monthly chart that had been in place since the 1980s, earlier this year, suggesting that interest rates are not in a secular decline anymore. They're actually in a secular rise. First real major resistance we're going to be watching is around this 5.3 area. We haven't quite gotten there. Here's on a daily chart. You can see we've got a pretty good uptrend channel that's formed. And we're starting to come to one of these support levels here between about 3.2 and 3.6. So we're going to be watching whether we can hold this level or not. it's looks like inflation has probably peaked, but isn't coming down super sharply. It's possible that rates could come up, double top, or even make higher highs. And if they do so, if we get a significant rally in rates further, that's likely to be taken as a negative by the market. So it's really something to watch out for. If we hold this level and begin to bounce in rates, that's likely to be market negative. And as rates have come off, the dollar's come off sharply. We've come off from 115 to basically 104 on the dollar. And now we are testing some really significant support. We're testing a former breakout level here in this 103 to 104 level in this zone here. And we're trying to bounce off that starting today. I don't know where that rally is going to hold, but really watch this 103 to 104. If we break down below this uptrend channel and this 103 to 104 level, it suggests that rates are really likely coming down more sharply, and the dollar is going to be coming down more sharply, and that's going to be less pressure on the downside for the market. But if we hold and we begin to bounce off these levels, that would be renewed pressure for stocks to watch out for. Then I've talked about it last month, but I just want to emphasize that you haven't had a recessionary bear market bottom in the stock market since World War II without a peak in bonds happening at least 2.5 months beforehand. And by at least, we're talking 2.5 months to as long as 24 months. So generally bonds peak or rates peak and bonds bottom at least 2.5 months before you get a bottom in the market. But I want you to understand is really rates peaked a little bit after stocks at the October lows. So we don't have any time on that 2.5 months. It's unlikely that the market is bottoming ahead of rates peaking. And you can see that that was the case during the inflationary 70s as well. Rates peaked at least 2.5 months before stock markets bottom, even when stocks were rising because the inflation rate peaked. All right, so let's take a look at our monthly list. We've got our ETF list. It's got fewer energies, but still some of them. And it's starting to get some industrials, starting to get some base metals, defense, healthcare, some dividend plays, some infrastructure plays, solar energy. We've had sort of clean energy in there for a long time. That's still holding up. And then I've got kind of a color coding for the major sectors. And then these are the VB is for very bullish. So the blacks are the ETFs that are showing the strongest, like on a 25 checklist of things that includes Zacks and Shaken and some other tools as well. And so I like to kind of keep track of that, and I put it on our list now. And you can see we've got industrials, we've got healthcare and biotech, we've got some financials, mostly insurance and brokers. We still have some energies and refiners. We have some infrastructure, some dividend plays, staples and foods, and solar and clean energy. And then we have now, for the second month, some foreign stocks. Last month was the first month that we had, and it was Turkey. Turkey's done extremely well. Now we have Turkey, Mexico, Japan, and some of the European indexes. And most of those are fueled heavily by that huge decline in the dollar. It's like an 8% decline in the dollar over the last month. And when you have dollar-denominated indexes, that means they're all rising by that plus. So it really helps the foreign indexes. And that's why that dollar trend is really important to watch. And on the downside, very negative that are in red, really the main thing is real estate. Also have some Bitcoin, also have some consumer recessionaries. So these are really the ones where if it looks like you get that breakdown in a 5 to 21 bar pattern off of resistance, and you get the strong volume traction or 80% down volume coming off that looks like it's a very clear correction over. These are where you really want to pay attention to sell short, at least hedge your exposure and potentially go net short. On the long side, we do have some things that look better than we had really in the August rally. The defense PPA, for example, is making new all-time highs and trying to break out of new all-time highs. So are some of the ultra dividend revenue vehicles. So those would be ones, if you're looking for longs, for your long exposure, those don't have upside resistance and are likely to continue higher if the market does continue higher. And then biotech has had this big 10-month base breakout. So it's got a lot of volume in here. You can see this is a huge HVN. And what that likely means is that even if we start declining, the ones that break out of substantial bases like this are likely to hold up better than the market as a whole. And then on the downside, we have some communications. So FCOM, we talked about last month, also have Bitcoin. I really like, if you're going to short Bitcoin, and we'll look at it at the end, but I like BITO, and because what BITO does is it basically keeps rolling nearby futures. This is similar to what UNG does for natural gas. When you do that, you basically keep paying for a premium, have that premium erode, and then pay for it again in that rollover. It's actually not a really good strategy for being constantly long, and it has sort of an embedded depreciation in it. And so if you're going to consider shorting something in the Bitcoin space, I really like this one. It has a lot of volume. It has options on it. And it has that embedded decline that will add to the decline that you get in Bitcoin and related entities. And then the other thing, of course, that we've talked about real estate is the main sector that is showing up as still being very negative. And so you've got potential topping formations, and you've got really you've got dozens of potential real estate ETFs that are in red there that you can look at. And so if we get a signal that the correction is over, these are ones that you would go to first to look and see where's the best pattern that looks the most reliable that I can get short with. On our longs, it's a bigger list this month. We got 2 pages of it instead of 1. And you can see here are our potential bases. So a lot of potential bases here. These are the ETFs, and in red are the stocks that are still basing. So if the rally continues and gets more legs, you want to be looking for breakouts in these. And then these are the post-breakout plays that already have broken out. So if you're a short-term trader and you want to capture some of the really super strong short-term, likely to outperform situations, you want to look in the post-breakouts on the long side. Good example, in phase just broke out. It's holding up relatively well even today compared to some of the others. So this looks like a valid breakout. This is a breakout to new all-time highs. It's a triple-digit earnings grower, and it's one of the groups that we're looking at as a top group. So if you're going to be considering long exposure, this is one on our list that looks pretty good. In terms of shorts, it's a little bit shorter of a list. It's got autos, internets, real estate, software, credit card payments, and consumer loans, and gaming mostly that seem to be among the weaker groups. We just had a breakdown in this enterprise software, Asana. This is new all-time lows. It's a weak group, and it has earnings losses. It's likely to continue down. Even if the bear rally continues, this is likely to hold up relatively well on the short side. And if we start to gain traction on the downside, this should be a leader. All right, let's look at some commodities. One thing, we talked about how gold is trying to form this false breakdown below really major support. We've done that now. And one of the things that's really fueled gold is this news that came out that we had more central bank purchases of gold in the last quarter than ever before in history. And so we've talked about in the past how we felt that the sanctions that the West did on Russia were really severe overreach. One of the things that they did that they've never done before in history is they actually seized the Russian central bank dollar-denominated asset. They seized them. And we talked about how that was really an overreach, because think about it, if you're another central bank that's not in the US and you've got assets in your central bank, you just realize that dollar reserve assets could be seized by the US at the stroke of a pen anytime. That's not the kind of safety that you want for reserve assets. So what we've had in response to that is we've had BRIC nations trying to reform a gold currency to denominate their trade in, because they want to be outside of the dollar, because they're afraid to hold dollar assets. And we've had China doing the same thing. So really the big dumping of the dollar, which led to a major decline of over 10% in the amount of trade denominated in the dollar, happened after 2014. 2014 is when the US led a coup in Ukraine and tried to basically get a friendly government to the West to take over. And so we've kind of had a civil war since then. And ever since 2014, the Russian central bank used to have huge dollar reserves, and it's essentially sold off all of them. And a lot of that has gone into gold. Now we see China starting to do the same thing. China is concerned about Taiwan frictions and other problems, and the US is sort of getting its companies to move towards friend-shoring and near-shoring instead of Chinese production for goods. And so China looks at what we're doing to Russia and says, you're not going to do that to me. So they're dumping their dollars and they're buying gold at a record pace. Now, we talked about last month how gold tends to bottom about 4 months before stocks do, because really it's recession often hurts gold because it just hurts all assets. People need liquidity and they dump everything that's liquid. But generally, gold is really sniffing out, when is the Fed going to shift and move toward ease? And once that happens, gold kind of leads that charge to say that that's starting to happen. We probably don't see that yet, and there's still potential for a further leg down, but this is a wild card that could have gold bottoming much earlier than normal. Really want to watch this HVN be around 172.50. If we can get over that, and you can see we're carving out a potential head and shoulder base here. If we can get over this HVN, that will be a stronger indication of a more lasting bottom and a signal to add some gold. The other thing I think is really important to watch just on an economic basis is what's happening with oil here. Oil's been extremely volatile in the last month, along with natural gas. And we talked about there's this sort of 75 to 77 support level. If it really breaks down and follows through below that, that likely means that the oil market is discounting a recession that's deepening. Whereas if we get over 96.20, that likely means we got supply problems that are overwhelming concern about recession. Right now, we're retesting this 75, 77 level. We've come off of this HVN. We made it sort of a lame attempt to try that 96.20 and couldn't get there. Really important, if we break down below these recent lows and start following through on the downside, that would mean recession imminent, the oil market really confirming that. And then you can watch the energy spider as well, XLE. It's in a range. And if it breaks to the highs, that will suggest that oil is going to be at least holding up. And if it breaks to the downside under 87.20 on a closing basis, and oil breaks down on that 75, you've got a lot of confirming evidence that we're heading for recession fairly quickly. All right, so Bitcoin has broken down, and we've got this failure of FTX. The government is trying to use that to do all kinds of regulation, but it is a real confidence problem, and the degree of lost assets looks like a lot of those assets were spent supporting Democrats in the last election. But regardless of that, the missing assets just keep growing. It was first 3 billion, and now we're talking about 8 billion and potentially more. And that means the repercussions. We've had now sort of a first wave of secondary bankruptcies happening among cyber currency firms that had, obligations from FTX. And so that's probably not over, and there's potential for another leg down. Now we formed potentially on a weekly chart basis this pattern I really like, which is a breakdown and an immediate flag. If we hold pretty much these prior lows at 17.5 as resistance and we break down and close new lows, I think that's a great sell signal and it's fairly low risk, at least for Bitcoin. And you could look at BitE and some of those other things as vehicles that could give you some real fuel if we're heading down into recession and cyber currencies are leading.
I will see you next week for Trader Tip Tuesday when we keep bringing this info to you to help you be a great trader. Have a great week. God bless.